year. So we should see positive growth of roughly around the 2% area, give or take. We're not looking for a big move up or down from the recent trend, which has been slowing towards that, what we think is a sustainable 2% trend. Inflation looks like it is going to stay relatively soft, although we think there's a little bit of room to move up from here. So kind of a steady as you go.
Looking at the 10-year now, 191, where do you think it's going for the year ahead?
We see some room for it to move up. We've got upper end around 2.25, maybe 2.5, and that isn't because we see a big move in inflation or a big move in growth, but we think the market in this quarter got too low on expectations of a lot more easing, of the slowdown in the global economy, and bond yields are really set in the global economy. And we think that the PMIs are starting to show a little bit of stability, maybe even a little bit of strength, so there's some room to move up to that 2.25 area.
And to what extent is the consumer pickup that we've seen in the second half of the year purely down to the Fed easing, and to what extent is it a sort of structural growth that holds through the next 12 to 24 months, regardless of what the Fed does?
I think as long as the unemployment rate is as low as it is and employment growth is still healthy, we'll continue to see a healthy consumer. So we've gotten a little bit of a boost from the Fed shifting to a really easy policy, but we've still got very low unemployment, and as long as that's the case, we'll continue to see reasonable consumer spending.
What are your issues this year?
The big concern we have in the bond market is the high yield market. Spreads, yields versus treasuries are very, very narrow on a historical basis. We know that a lot of companies are not earning enough to generate the cash flow they need to pay their bond holders. Covenants have been weakened, so we're concerned about valuations there, and we're very cautious in the high yield market right now.
So it's not trade, though.
Trade, we think, is just a long, slow, drawn-out process, but the escalation of trade conflicts that we saw earlier this year has now turned into de-escalation, and so we're not as concerned unless it starts to escalate again.
Mm-hmm. And what was the other thing I was going to ask you about there? So we do not have the specter of a recession staring us. What was your highest percentage when we were all looking into the abyss in the last 12 months? Where did you ever get to 40%?
No, we didn't. So if you look at the probability based on the yield curve alone, you could get to 40 or 50% earlier this year when we had the yield curve inversion. But we also look at credit spreads, and credit spreads never really got to the point where they were signaling a tightening in credit conditions or the inability of companies to get financing. And for me, that's the big one. So you can have an inverted yield curve without getting a recession as long as credit conditions are really easy. And the Fed easing, of course, has helped out quite a bit.
Kevin, when you look at some of the sector performance in the year past, it's pretty divergent. 48% technologies led the charge. Can that repeat next year, that level of sector leadership?
The first 2 quarters of next year, I think we're going to see a continuation of the strong consumer, and that's going to help consumer discretionary, notably e-commerce. And also we're going to see a continuation of the trend we've seen in biotech, M&A. We saw 28 deals announced in 2019. We think that pace is going to continue in 2020, mostly because downward pressure being put on drug prices, a lot of these major revenue-producing drugs coming off a patent, being subject to generic pricing, and the fact that a lot of the large pharmaceutical companies have cash on their balance sheets and don't have their own pipeline to turn to. So those are 2 areas that we see. In terms of other risk areas, not only do we see trade as a potential risk and additional tariffs if they are introduced, but remember we have 4 new voting members of the Fed coming on board this year. We all are assuming the Fed's going to do nothing in 2020. So that's a potential uncertainty and potential risk.